It's an honor, it's a privilege to deliver G. Ramachandran Memorial Lecture. I use the word privilege consciously because this occasion brings together three enduring values, as Mr. Shankar also alluded to. Three enduring values: the memory of a distinguished public servant, the intellectual setting of this Madras School of Economics, and the long institutional legacy of the Southern India Chamber of Commerce and Industry. Sri Ramachandran belonged to the generation that helped shape India's economic and financial institutions in the early decades of the independence. A first-class first in economics from Madras University, and a topper in all-India examination for the civil services. He served with distinction in Tamil Nadu, became its youngest finance secretary, was later handpicked for the Prime Minister's Secretariat, and eventually rose to become the Finance Secretary to the Government of India. He was closely associated with major economic policy measures, including bank nationalization and poverty alleviation, and later retired as Executive Director of the Asian Development Bank. His career is a reminder that economics and public policy ultimately derive their meaning from their impact on people, institutions, and the broader economy. I must also acknowledge with deep respect and admiration the presence of Dr. C. Rangarajan. His contributions to Indian economic thinking, monetary policy, financial sector reform, and institution building occupy a distinguished place in the annals of our economic history. His long stewardship of the Reserve Bank, marked by scholarship, judgment, and institutional commitment, has become part of our professional folklore. It is truly humbling to be speaking in his presence today, and we are grateful for the distinction he lends to this occasion. Thank you, sir. I speak today in the presence of eminent economists, the members of family of Sri Ramachandran, and also the students of economics. I do so not as a professional economist, but as a career banker and a banking supervisor. So my perspective is therefore that of a practitioner. I have great respect for economic theory. I have even greater respect for what happens when theory meets reality. The subject on which I wish to speak today is on learning, judgment, and supervision. Lessons from my own banking career. So my core theme is that banking cannot be understood only through numbers, models, or regulations, though all three are important. It must also be understood through experience, institutional behavior, and the public purpose that finance is meant to serve. In that sense, a life in banking has offered me three educations: the education of the classroom, the education of the banking counter, and the education of supervision. Each offers a different lens, and together they have helped me understand banking more comprehensively. It is this experience that I would like to share, especially with the students gathered here today. So let me begin with the classroom. Economics first came to me through examination papers, like many of you would have encountered, through examination papers in school and college. The themes were in many ways evergreen: demand and supply, money and banking, public finance, international trade, national income, and business cycles. These are the most familiar themes all of us had. Like many students, I understood them well enough to write and clear examinations. But I do not think at that stage I fully appreciated how deeply they would later shape my understanding of banking and finance. It was only when I entered banking that many of these ideas acquired life. Demand and supply were no longer only curves in a textbook. They could be seen in the appetite for credit, in the pricing of funds, and in the behavior of our borrowers. Money and banking, which had once been a paper in the curriculum, became the world in which I worked every day. That is why I say, with the benefit of hindsight, that a good education in economics is a powerful thing. It teaches you to ask questions that are simple in form but deep in consequence.